Now, morning once again, ladies and gentlemen, welcome to our day treatment. And I'm so sure that parents over here would want to take time to prepare their kids to go to church, and I would not want to waste your time quite a lot. I just want us to look at some small topic here called impairment. Impairment of what here? Impairment of assets. Impairment of assets. And I would want to look at a very practical case here of RCM Online College. RCM Online College, ladies and gentlemen, when we talk of impairment, we are looking at our assets losing value, right? Assets losing value, loss of value, which is beyond the normal depreciation, And now at RCM Online College, do we have really huge assets? No. The kind of assets that we can only talk of us having are these ones here, right? Great cameras, good cameras. So assuming we have this kind of a camera, and then we subject it to some impairment review, then what we shall do, we have three key things. Whenever we are reviewing an asset for impairment, we have three key things. We have what we call carrying value. This is the book value, isn't it? Or the net book value. The value at which we are carrying our cameras at in our books. Of course, it will be the cost minus depreciation accumulated. So number two, we have what we call value in use. Value in use. So remember, for value in use, we are assuming if we don't sell this camera, I mean, what cash flows are we going to generate out of it? If we don't sell this camera and then we dedicate it to advanced level students, in this case here, we look at the numbers, cash flows, like every year, how much in this case here shall we derive as a value by using this camera? The other thing, ladies and gentlemen, lastly here, is what we call the fair value, which is the same as market value. Should we decide to sell this camera? If we decide to sell this camera today, how much shall we fetch less any selling costs? Now, assuming I have a value in use, of course, value in use, we normally use the concept of discounted cash flows. So assuming we have a value in use of, say, 1,000, maybe in thousands like that. Value in use is 1,000. Then we have fair value, market value. Should we decide to sell this camera today? Perhaps we have, in this case here, a value, or rather a fair value of 2,000, less costs of selling, for example, brokerage fees. For example, in this case, you may need to pay whatever, all the costs that you're going to incur to sell, advertising, etc. You must deduct this from its fair value, less costs to sell. All right. So we have 2,000 there. And then carrying value of this asset, in our books is 3,000. Carrying value of this asset in our books is 3,000. Now listen, the first thing, when you give me these three values, when I come to your company as an auditor, you give me these three values about a particular asset, then I will come and construct this tree. This will be a very important tree pointing to these two possibilities of this camera. That this camera, I can either decide, hold on to it, use it, generate cash flows, discount them, get value in use. Or number two, I can decide to sell it today. If I sell it today, I'll be able to get this 2,000. So these two metrics are very important to us because they shall always help us to get what we call recoverable value or recoverable amount. Remember, recoverable amount comes out of the wisest decision that you will make. The wise decision that I will choose here, if you tell me this, that if I continue holding onto this camera, I'll only get 1,000. If I continue holding onto this camera, I'll only get 1,000. And if you tell me, of course, that if you sell it today, you'll get 2,000. Where am I better off? Between those two options? Should I sell the machine today and get 2,000, or should I 2,000, isn't it? 2,000. So it means that overall, this camera of mine, I'm going to make a wise decision and sell it today, meaning that the recoverable amount, the recoverable value, recoverable amount is 2,000. Remember that recoverable amount is normally the higher of the two, the higher of these two, the higher of these two. Now from there, I know how much I'll be able to recover from this camera. I know how much I'll be able to recover from this camera. It's 2,000. So knowing that I can only recover 2,000, and then you look at this amount which I'm carrying this thing at. In my books, I'm saying that this camera is worth 3,000. And on the ground between tofauti, I can only recover how much? 2,000 out of it. There is a lie there. There is a loss in value, which should be recognized immediately. So anytime they tell us, ladies and gentlemen, here to calculate impairment loss, anytime they tell us to calculate impairment loss, this is how we calculate impairment loss. To calculate the impairment loss, you basically, in this case here, you compare the recoverable amount vis-a-vis here, in this case here, the carrying amount. Those two things, you compare. Anytime you want to get impairment loss, you compare. And we will always say that impairment loss has occurred when you are able to recover less than what the carrying amount is. When the recoverable amount is less than the carrying value, then automatically we will say here that this asset has been impaired. Like in this particular case, you can see our recoverable amount is 2,000 vis-a-vis our carrying value, which is what here, which is 3,000. So this asset is impaired. This asset is impaired. So it will be very important for you, ladies and gentlemen, always to remember this concept of what here, impairment loss in this context. I hope this small example makes some sense. I hope this small example makes some sense. Are we together, really? Are we together? Are we together? Are we together? Are we together? Great, great. So those three things are very important. So I would want to do just one question, and then we forget about this. And this question on impairment is the September 2021, question number 5C. September 2021, question number 5C. September 2021, question number 5C. Packer Limited. Once you get the question, ladies and gentlemen, please put your hands up. Please put your hands up. Of course, not where you are seated. Don't start raising your hand up because I'm not able to see. There is a hand that you can put up in Zoom. Thank you, Mary Ann. Thank you, Mary Ann. So in this case here, I'm reading it from our revision kit. We are told here Packer Limited acquired 100% of Angaza Limited on 1st October 2017. Angaza Limited exports electrical materials across the world. As at the date of acquisition, goodwill of 12 million was calculated. The entire amount of this goodwill has been outstanding since then, because Angaza Limited's recoverable value has remained higher than its carrying amount. Remember, when recoverable value is higher than the carrying amount, then that is very good. There is no impairment. There's no impairment. If recoverable amount is higher, that's very good. But if recoverable amount is less, if you're able to recover less amount than the carrying, then that is an impaired asset. It's an impaired asset. Even human beings, by the way, get impaired after some time. And that is why I always remember to give you this analogy of the CBK pension towers. CBK pension towers, which is around there where Kiare is. If you go there, you'll be able to see these pension towers, and they normally impress me so much because of how they are bending, They're twin towers. They are bending like that with a very strong foundation, that regardless of how strong today you are, it doesn't matter how strong a foundation you have. You could be one great astute gentleman who is walking straight like this, very straight today. But the moment you hit 70 years, whether you like it or not, you will bend. You will bend like these pension towers. the inspiration. They're bending like that 70 will bend. So then they're telling us, when you'll be bending, you'll only be comfortable if today you are making contributions towards your pension scheme, especially a private pension scheme. Very, very important. So one day you shall be bending. So even a human being, ladies and gentlemen, trust you me, utachapa tu, utachapa, utakuwa impaired. So you need to take a cue of that and work very hard when you are this young. Great. So then we are told, ladies and gentlemen, there, Angaza Limited's business is divided into two cash generating units. We have the industrial division and the domestic division. When Angaza Limited was originally acquired, the shillings 8 million of goodwill was attributable to industrial division and shillings 4 million to the domestic division. So we have industrial division there, we have domestic division there. In relation to the recoverable values of the divisions, it has not been possible to establish the net selling price. It has not been possible to establish the net selling price for either division, but an estimate was received of the future cash flows for each of the CGUs for the next 5 financial years. These were as follows. So I can see the operating cash flows. I can see operating cash flows for industrial division. I can see operating cash flows for domestic division. Additional information, the industrial division could be sold at the end of year 2025 for an estimated 6 million. The domestic division would be held indefinitely, generating cash flows of 1.5 million per annum in perpetuity. The pre-tax cost of capital of Angaza Limited division is 8% per annum, and the rate of tax is 30% per annum. The following discount factors have been given. So they want us to calculate the impairment in conformity to IAS 36, impairment of assets that should be recognized in the group financial statements for the year ending 30th September 2020 in relation to Angaza Limited. Most students here, what they were not able to get is the value in use. Whenever you see in advanced financial, even if you don't understand this thing very well, whenever you see cash flows being given, and you are seeing in this case here, this guy is giving you discounting factors, please get present, even if you don't understand anything. Get present values. And this normally comes under leases at times, impairment of assets, or under financial instruments, those things that we call convertible bonds that you are required here to split between debt and equity instruments. Do you remember those kind of questions of convertible bonds where you're required to split debt and equity instruments where we use discounted cash flow method? Do you remember that concept? Kendi says yes. Any other student who is able to remember that concept, convertible? It's only one student who remembers, then they are able to remember. I'd not ask whether you know how to do the question, but at least, is it there in the syllabus? 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 Right? Is it there in the syllabus? We shall overcome. Now, ladies and gentlemen, please listen and listen to me very well. When I'm given cash flows, like in this context of IAS 36, they want me to assume that I will be holding onto this asset. If I hold onto this asset, then I will be using the asset. If I use the asset, I will be able to generate cash flows. I'll be able to generate cash flows. So basically, those cash flows that are given there, they shall be used to compute the value in use. Value in use. Value in use is our discounted cash flows. 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 So we shall start with the industrial division. So the industrial division, I will copy this very first. Industrial division, I will copy this very fast. We have the year 2021. We have the year 2022, we have 2023, we have 2024, we have 2025, and then they have given us cash flows. They have given us cash flows. They have given us cash flows. The first cash flow in 2021 is 1,500. The second cash flow is 1,500 as well. The third cash flow is 1,000. The third cash flow is 1,000. The fourth cash flow is 1,000. The fifth cash flow is 1,000. The fifth cash flow is 1,000. Are you able to see those cash flows, ladies and gentlemen? Are you able to see those cash flows? Yeah. Great. Remember, IAS 36 tells us to ignore taxation and any financing effects. When it comes to picking cash flows, IAS 36 is very categorical. It tells us never work with the cash flows after tax, cash flows after interest. They tell us to use what we call operating cash flows. And that is why I've picked the operating cash flows only up there. I don't want to deduct interest. I don't want to deduct taxation, because that is what IAS 36 tells us. Is that true? Is that true? Is that true? Great. Thank you so much. Now, there is one cash flow that so many students in this case here forgot, that the industrial division could be sold at the end of year 2025 for an estimated 6,000. So in this case here, this 2025, there is a terminal value. So terminal value, I've got two ways. You can come and add this terminal value here, or you can just come and duplicate 2025 square mbili. Unajua hapa kuna terminal value of 6,000. Because they have told us that this industrial division, you can sell it. You can sell it. So there is a disposal cash flow coming at the end of year 25. A disposal cash flow coming at the end of year 25. Now, so what you need to do is you come here and give us the discounting factors, what we call the PVF. In AFR, the PVF will be given to you. The PVF will be given to you. But if they don't give it to us, we know, like now here, they have given me the cost of capital. They have told me the cost of capital in 03, the pre-tax cost of capital there is 8%. I would have used that 8%, but in AFR, they normally give us. And if you are given, don't try to stretch your muscles to show anybody that you are tough. KASNEB doesn't recognize those kind of muscles. These discounting factors, I'm picking them from note number 4. I'm picking them from note number 4. So 0.35, and then we have here 0.681. So what do you think of this terminal cash flow? Which discounting factor will I put here? If I'm using this approach, I simply drop this down. It's a 2025 cash flow. So I'll simply come and use the same 0.681. So abracadabra, could you then kindly come here and give me discounted cash flows? Could you come here and give me discounted cash flows? Now we are multiplying very fast, this and this. Give me a value. Give me a value. So according to Gideon B, it is 1389. According to Gideon B, it is 1389. And then we go to the second one. The second one, what do we have here? It is 1286 from Ukabeth. 1286. 1286. Then we have this one I know, 794. This one I know, 735. This one I know, 681. This one I wish I knew it. The last one I wish I knew it. The last one I wish I knew it. Okay, so they're giving me a figure of 4086, like that. So in this case here, come and give us the total. Come and give us the total discounted cash flows. Come and give us the total discounted cash flows. Come and give us the discounted cash flows total. So this is 8971. 8971. So in this case here, this is the value in use. If we continue using this thing, we shall derive this benefit. We shall derive this benefit. So I hope you guys will be able to remember this figure. Mine, I would want to wrap my board, but I know you guys will be able to remember this figure. So can I go ahead and calculate the value in use for the next division? For the next division, which is a domestic. Domestic, thank you so much. So I'll go ahead and calculate the value in use for domestic. I will go ahead and calculate the value in use for domestic. I'll go ahead and calculate the value in use for domestic division. For domestic division. For domestic division. So domestic division, remember, I'm only picking operating cash flows. Don't be cheated by these examiners easily and take the after-tax cash flows. IAS 36 is against taxation. IAS 36 is against interest. IAS 36 tells us to work with operating costs, operating cash flows only. So the operating cash flows, we have 2021, it is 2,000. 2,000. We have here 2,000 again, the operating cash flows, 2,000 again. We have 1,800. We have 1,800. We have 1,800. We have 1,850. We have 1,850. And then we have 1,850 here. But this one, I like this person because he came us and he gave us the perpetual cash flow. He gave us the perpetual cash flow. He told us in note number 2, the domestic division would be held indefinitely, generating cash flows of 1,500, I've chopped those 3 zeros, of 1,500 per annum in perpetuity. The only thing he forgot there is to say after 2025, after 2025, unlike the industrial division that we are going to sell, after 2025, we shall hold onto this domestic division, and of course, it shall be able to generate for us cash flows of 1,500 per annum in perpetuity. So for perpetuity, do you remember that you have to calculate PO? Anybody who is doing AFM, this should be very easy. For perpetuity, remember you must calculate PO. And remember, when you are calculating PO, you always think of our Deputy President Gachagua, that provincial officer equals district officer who has to grow in ranks. And for sure, this guy grew in ranks. He did not even become a provincial officer. He grew in ranks from DO to deputy to MP and the deputy president. So in this case here, provincial officer will always be equal to district officer who grows in ranks like that all over Kenya without government. 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 So remember, PO is the current market price. DO is the current dividend. G is the growth rate. KE is the cost of capital. G again here is the growth rate. So when I come and calculate this PO, this current value, we use this formula for perpetual cash flows. So then come here right away and give us the PO. PO will be equal to the most current value. The most current dividend is this one here. The most current dividend is this one here, which is 1850. This question, the examiner, DO is the current dividend, but for us here, we take it to be the current cash flow, the most current cash flow. Most current cash flow is 1850. Most current cash flow is 1850. This examiner never told us whether these perpetual cash flows will be growing. He just told us 1,500 constant like that. So basically no growth rate here. But if I was to test this question this time around, I'll put a growth rate because I know the moment I put a growth rate, especially for students who are not doing advanced FM, if I put a growth rate into some perpetual cash flows, then I'll be able to throw most of the students under the bus. And really, that is the wish of any good examiner. A good examiner, I know we are in some wrestling battle with you. And I have to strive to be the Yokozuna, to be on top of you, in this great match. All right? So there is no growth rate here. So you're saying growth rate is 0. So 1 plus 0. All over, have they given me the cost of equity? Do we have the cost of equity? Do we have the cost of equity? It is 8%, isn't it? It's 8%. Thank you so much. It's given in note number 3. So it is 0.08 minus the growth rate, Growth rate again is what here is 0. So then our PO, ladies and gentlemen, our PO basically will be 1850 divided by 0.08, divided by 0.08, divided by 0.08, divided by 0.08. I can see somebody who is very sensitive with political matters, mentioning there that Mwalimu, you have used a bad example, that Kenya without government. I was using Kenya without government example even during Kibaki's time, because that is how I make my students in this case here understand what here this formula is very easily. Great. So don't take offense really. Don't take offense really. So they've given me a figure here. They've given me a figure here. PO equals 23,125. And then remember, please, for the discounting factor of this, For discounting factor of this, we shall always drop this down here. We shall always drop this down here. We shall always drop this down here. Kenya, we have a government. You must always know how to work with government of the day. You mambo ingine yote muache kabisa. You must work with government of the day for development. Other things for economic stability and whatever, lazima sasa iende namna hiyo. Hakuna mambo ingine. So kuja hapa, tupatie hapa discounted cash flows. Discounted cash flows, what do we have? Somebody, what do we have? 2,000 times this, give us a figure. So Mary Ann gives me 1852. Mary Ann gives me 1852. 1852. 1852. Then we have from Gideon B, 1714. 1714, Gideon B is among those guys who love Mwalimu Aura. Gideon B alikuwa ameenda shule ingine, akalipa fees huko. Alipoona Aura yuko huko, akatoroka. Akalipia, akaniambia mwalimu inakuja mahali huko, wewe wacha nilipe fees bara. Yeah, and I think Gideon, you are now getting value. Aren't you? $1,500 in note number 2. In note number 2. That's 1,500. Yeah. Poleni sana. Poleni sana. That student is bright. That student is bright. That student is bright. We have done a mistake here. So to own up. We have done a mistake here. We have done a mistake here. We have done a mistake here. You know, I've picked this thing literally from AFM, where we say the most current is what is 1850. But you see, in this question, they gave us this perpetual cash flow. I'm so sorry. They gave us this perpetual cash flow. They gave us the perpetual cash flow in note number 2. The domestic division will be held indefinitely, generating cash flows of 1,500. I'm so sorry for that. But are you able to see? Are you able to see that 1,500? Are you able to see that 1,500? Somebody else has also seen it. 1,500. Thank you very much. 1,500. Thank you very much. I'm so sorry. 1,500. This time around we are given. So let us go to this PO formula again. So in this case here, then our DO, the cash flow to use is 1850. So it will be 1850, not 1850, should be 1,500. Why am I falling in love this morning with this 1850? Should be 1,500, divide this by the cost of equity, which is 0.08. 0.08. So then could you kindly give me this figure now? Could you kindly give me this figure? Could you kindly give me the, oh, it's 18,750, yeah? Hey, that figure is following me throughout. That figure is following me. Now it has a 7. I don't want it to follow me. 18,750 like that. So I'm so sorry for that, but I believe it was for good. We have learned something. We have learned something, yes. So now let's get back and continue with this. Let's get back and continue with this, and this gives me what figure? Please give me a figure now that I've mentioned about Gachagua, and I have to keep on using this, the way he throws his hand like this, for you guys to move very fast. So current TJ tells me 1260, 1260, 1260, 1260. The fourth one, most could have missed it. Yes. The fourth one, haiwezi kuwa hivyo kubwa hivyo for zio mendanganya. Haki 12,000. Na hii figure 1850 hizi kuwa kubwa hivyo for. Ama unasema hii ya mwisho. Last 12, hii ya mwisho ni 12,769. 12,769. Thank you so much then. 12. $12,769. There are figures we are missing in between here. There are figures we're missing in between here. Please give me these figures we are missing here. 2023 is 1429. 1429. And I suppose that is 1260 now. Is there any other figure we are missing in between? Please give me the total. I'm not even interested now with these ones. Give me the total. Which will be the value in use? Which will be the value in use? The value in use. Which will be the value in use? Just give me the total. Year 4, I'm being told is 1360. There is a 1360 or something like, I don't know. I know you have those figures. Elizabeth has them, all of them, 1360, 1260. 1360 and then 1260. I think that's good enough. Just give me the total. Benjamin Bosire gives me 20, 2384, 2384, 2384, 2384. Now from there, abracadabra, give us the impairment matrix. Give us the impairment matrix now. Give us the impairment matrix. So impairment matrix, you're comparing two things. Impairment matrix, you're comparing two things. The impairment matrix, impairment matrix. We have two divisions here. We have industrial division, industrial division. So under industrial division, I'm concerned with the carrying value vis-a-vis carrying amount vis-a-vis recoverable amount, vis-a-vis recoverable amount, carrying amount vis-a-vis recoverable amount. Then I have domestic as well, like that. Oh yeah, domestic, like that. So have they given us this carrying amount? Have they given us the carrying amount of these two divisions? Yes. If you look at the first table up there, the carrying values of Angaza Limited's cash generating units at 30th September 2020, we are looking at the entire division. So the entire division, without looking at the individual components there, industrial division, I can see the carrying amount is 13,870. 13,870. And then domestic, I can see domestic is 69, 69, 69, 69, 75. 69, 75. And then I can see domestic recoverable amount is 2384. 2384. By the way, there is something I forgot to tell you. There is something I forgot to tell you. Remember, they told us that these divisions, you can't sell them. You can't sell them. I mean, I can't sell them. Like if it is division, if for example, it is domestic, I mean, if it's domestic, when I want to get a recoverable amount, you know, there are two options. Either I sell and I get fair value, less cost of sale, or I use. If I use, I'm going to get value in use. The usasa, I'm going to get value in use. So in this case here, we are not going to sell these divisions today. We are not selling them today. That's what they told us up there. They told us up there in this second paragraph, in relation to the recoverable value of the divisions, it has not been possible to establish the net selling price for either division. For now, you have got really nothing to compare, right? So it means that whatever you have here, like for example, domestic recoverable amount value in use, you have this value in use domestic, you have 2384. So because I don't have a possibility of selling, I just chose the value in use to be my recoverable amount. Is there somebody who can remind us the recoverable amount of industrial? Recoverable amount of industrial. So there is no reason for you to look for higher. Always, they're mentioning something to do with goodwill. They're mentioning something to do with goodwill. No. 8971. 8971. 8971. The goodwill, we shall go to goodwill when we'll be looking at how do we apportion impairment loss. Goodwill becomes, in this case here, the first casualty. They want to be knocked first when we are allocating impairment loss, but you can't bring it in this working year. You can't bring it in this working year. All right. So they come very fast and they create a column here for impairment loss. See, when does impairment loss occur? Impairment loss occurs whenever your recoverable amount is less. Recoverable amount is less. Recoverable amount is less. Like industrial, you can see industrial recoverable amount is less. So when recoverable amount is less, yes, there is impairment, and the impairment loss will be 13,870 minus 8,971, which will give us what figure? According to Mary Ann, it is 48.99. Mary Ann, 48.99, like that. How about impairment loss for domestic? How about impairment loss for domestic? Nil. Nil, because you can see the recoverable amount is not lower. The recoverable amount is higher. So then in that case, ladies and gentlemen, no impairment, yes. In this particular case, we only have one division that has been impaired, one division that has been impaired, one division that has been impaired, one division that has been impaired. So in my books of account, I will be able to have this impairment loss go to the income statement. And in the balance sheet, there will be something that will be reduced. In the balance sheet, if you look at this industrial division's goodwill was 8 million. Now the goodwill has to go down. If you remember, industrial has some goodwill. So the new goodwill amount for industrial, the new goodwill amount for industrial, the new goodwill amount for industrial will be 8,000 minus whatever you got here. Fortunately, it can absorb everything. Fortunately, it can absorb everything. So the new amount of goodwill will be equal to 3101. So is that okay? If it cannot, of course, remember those procedures. If it cannot, now the balance will go straight away to number one, specific assets which have been impaired. Anything again extra, you apportion it proportionately to the other assets. Somebody called Mary is saying the impairment is 6514. The impairment is 6514. I don't know how she got the impairment at 6514, but the most important thing is that we are not looking for perfection again. I choose not to look for perfection. So long as you have understood the concept a little bit, and then you will be able to do what here, you will be able to at least use that concept here to get something, some few marks. That really makes me happy. So I don't want us to start looking at where have we messed. No. I think that is sufficient. If you allow Mwalimu, you should be able to go to the next question. Have you understood something? Have you gotten some new perspective of this question that you never had before? Anybody who has gotten some new perspective? Anybody who has gotten some new perspective that they never had before? They never had before, at least now they, great. At least somebody has gotten some new perspective, Now, when you look at this question here, May 2016, question number 4A. May 2016, question number 4A, with reference to IAS 36. That's a theory question. Discuss the treatment of impairment loss. I'll start from very far away. This kind of a question, I'll end up getting all those marks without knowing really what I'm even saying. I'll start by telling them how impairment loss arises. Impairment loss, in this case, how does it arise? It arises whenever recoverable amount, in this case, is less than what here? Carrying value. And whenever I get this impairment loss, what should I do? I should start reducing values of assets. If it's a cash generating unit, I'll start reducing values of assets in this order. First of all, we exhaust goodwill. After exhausting goodwill, we go to specific assets that have been done. What here, somebody? Specific assets that have been impaired. After you exhaust that kitty, now we go to the other assets whose net loss, the remaining loss, now will be shared proportionately to the other assets. Remember, number one, you start with goodwill. You exhaust it fully. Right? So perhaps in this case here, I should be able to do some illustration here to demonstrate what I'm talking about. Assuming, ladies and gentlemen, you have a cash generating unit, which looks like this. So we have goodwill here, all right? So we have in this case here, for example, camera, which in this case here we have discovered it's fully impaired. So specifically this one here we identified, it's fully impaired. And then RCM could be having a small car to help. So we have here motor vehicle. in this case here, worth, for example, 1 million, 1 million, 1 million. And then we have what do we have again? I'm trying to imagine what we have. Let's talk of just furniture. Furniture. We're not a very rich company. Furniture, 2 million. Furniture, 2 million. All our offices like that. So goodwill could be something like, for example, 0.5 million. 0.5 million. And then now we do an impairment review. We get an impairment loss of 3.5 million. 3.5 million. We get an impairment loss of 3. This camera which is fully impaired, let's give it how much? Let's give it also 1 million. Let's give it 1 million. A camera which is, cameras are very expensive. Let's give them 1 million. Let's give them 1 million. Great. So then this impairment loss, how shall it be recovered? Number one, so I'll come and write here 3.5 million. 3.5 million. So this is the impairment loss column. Impairment loss column, right? So this 3.5 million, ladies and gentlemen, how shall I distribute it? Number one, I will drink the whole of goodwill. The goodwill here has to disappear, the whole of it. This asset has been identified specifically as fully impaired. So the entire amount, in this case, of course, after taking 500,000, we still have what here? We still have. How I wish, let's make this 3 million. Let's make this 3 million flat. 3 million flat. Let's make it 3 million flat. 3 million flat. 3 million flat, yes. Let's make it 3 million flat. 3 million flat. So, ladies and gentlemen, we have 500 has been utilized here, has been taken by goodwill fully. It's a useless asset. There is no way you will get your business impaired, and yet you're carrying things like goodwill in the financial statements. It's not possible. Then we have in this case here, this other asset that is specifically fully impaired. So of course, we have some remaining good amount of impairment loss. We shall come and take this one here, 1 million. So ladies and gentlemen, then after taking this 1 million, the other assets, there is no specification now. No specification now. So then I'll come and get there, what we call the remnant here, or the remaining. The remaining, after doing the known impairment loss distribution, there is a remaining impairment loss. So this remaining impairment loss, abracadabra, will be 3 million minus what you have been able to distribute, minus 1.5 million, which gives me 1.5 million. So now this is what will be prorated to the remaining assets, right? And then now, of course, we are using these remaining assets here. I mean, what are their ratios here? You see, like motor vehicle now is 1 out of 3. It's 1 out of 3. You don't use these other values. You have already done away with them. So it'll be 1 out of 3 times 1.5 million loss. So could you kindly give me a figure to take here for motor vehicle? It's 1 out of 3, 3 total, times 1.5 million. How much do I take here? What are somebody 500,000? 500,000. And then, of course, furniture will be 2 out of 3 times 1.5 million. 2 out of 3 times 1.5 million. All right. Which in this case, will give me 1 million. So in that case here, then you have been able to account for the impairment loss. And then we'll have another column here for what here now for the new carrying amount that will take to the balance sheet. The new carrying amount will take the balance sheet. Like now I'll be having my motor vehicle having only 500,000 and furniture having only 1 million. So I hope I've answered somebody. So in relation to impairment loss, I will first of all define in this case here how impairment loss occurs. And in this case here, the procedure, especially whenever we have some cash generating unit, I'll go ahead even to tell them that my impairment loss distribution will follow some pattern. First of all, I exhaust the goodwill. From there, I go to specifically impaired assets. And then from there, any other remaining assets, we do a proration of the remaining what year impairment. The other thing that I will talk about, ladies and gentlemen, in terms of treating impairment loss in the books of accounts is this, that any impairment loss for non-revalued assets, impairment loss for non-revalued assets shall always be debited to P&L. I'm repeating again that impairment loss for non-revalued assets shall always, in this case here, be taken to the profit and loss. But impairment loss for assets that have been revalued. Remember, when you revalued an asset, you took that revaluation gain to the OCI, what we call other comprehensive incomes. So should you resign, should you, in this case here, realize there is an impairment loss of this asset that you revalued, that impairment loss will be taken to the OCI, So if I were you, those are great things that I'm mentioning there, that in terms of accounting treatment, if we are talking of impairment loss of non-revalued assets that have not been revalued, then the impairment loss will go to the P&L. But if we are talking of impairment loss in terms of accounting for assets that have been revalued, then that impairment loss will go to other comprehensive incomes section. Other comprehensive incomes section. And then please never forget that when you are apportioning impairment losses, you can never reduce the value of an asset to negative. The lowest should be what here? 0. There is no way you can ever, after doing apportioning your impairment, that's an accounting concept. Whenever you're doing impairment losses, you can never take an asset's value to negative. How do you carry it in the books of accounts as a liability? It's not possible. It's not possible. So can I move to something different? Can I move to something different? Can I move to something different? So because this is a free of charge class, this video, I'm going to put it in my YouTube channel. And by the way, I'm so happy. Yesterday, I looked at how much I've earned from my channel. I was so happy. It means that you guys, when you are watching, even when you are closer to exams, it's like you don't skip adverts. It's like you don't skip adverts. It's like you don't skip adverts. I got very good cash flows in form of dollars. Actually, I think the next thing that we should be doing, all of us, is YouTube. YouTube is very good. It can easily give you very good passive income. Can easily give you very good passive income. So of course, that YouTube channel, let's make it our own, right? By subscribing, don't forget. Thank you.